When President Trump launched widespread tariffs on April 2nd, most economists feared the worst. Tariffs, they said, would increase inflation, disrupt supply chains and hurt economic growth. And yet the US stock market continues to defy the odds, with the Dow Jones, S&P 500 and Nasdaq all hitting record highs. In fact, the S&P 500 has now advanced for 5 straight months, gaining over 30% since those April lows. But despite the gains, a different picture emerges when you look under the hood. Economic data for the first half, for example, shows that growth did indeed slow to just 1.2%, while inflation remains high and unemployment ticked up. And while the S&P 500 has climbed 12% this year, the US dollar has fallen by a similar amount, partly driven by Trump's bloated spending bill and his attacks on the Federal Reserve. At the same time, a large portion of the market's gains this year have come from just a handful of stocks. The Magnificent Seven, which includes Nvidia, Google and Tesla, are up a combined 18% this year, with those 7 stocks now constituting almost 40% of the index. Meanwhile, stocks linked to the real economy like restaurants, consumer retail and real estate have performed poorly, with many down double digits like Lululemon, Carver and Crocs. And so the stock market this year is largely being driven by one thing: a tidal wave of investment in artificial intelligence that is propelling demand for chips, data centers and energy. This in turn has created extreme valuations for many AI-related stocks, and we've seen a resurgence of meme trading in stocks like OpenDoor and quantum computing stocks. And so the big question is, how long can the AI euphoria last? A slowdown in AI capital spending would cause a double whammy for the stock market, because it would cut economic growth and cause AI stocks to fall. That would lead to a negative wealth effect as stock market investors cut back real economy spending on goods. This is significant because, according to Moody's, the top 10% of US earners now make up half of all consumer spending in the US, and consumer spending drives around 70% of US GDP. But it is possible that AI investment continues for a while yet. Oracle's earnings last week certainly showed no sign of a slowdown, as the company revealed a 359% increase in future revenue obligations and a $300 billion contract with OpenAI. Even so, there are clearly signs of euphoria in many parts of the market, and it's always risky to buy stocks when valuations are so high. But these are my personal opinions, not financial advice, and if you want new investing ideas, make sure to join my newsletter at 3minutebreakdowns.com. Thank you for watching.